This is In the Final Analysis.
Welcome to an In the Final Analysis Minisode, our first of 2026. This is your host and financial advisor for Wisdom Financial Management, Joe Frederick, and I am the media support manager, Kylie. Hi, Joe. How you doing?
Great, Kylie. How are you?
I'm
Excited?
doing
Excited to get the year going. This is
Yes, same. I
some-
know we're so excited to be back for another Minisode, which is special topic episodes of our In the Final Analysis podcast around financial literacy and education, behavioral finance, and anything people need to know about the finance world right now. And today, for our first Minisode of the year, we are going to be starting a new mini series about interest rates. And today's episode specifically is going to be analyzing banks and their role with interest rates. So, to get started, let's just lay it down to the basics for our listeners. How do our checking and savings deposits work in banks? Where are where in the cog of the banking machine are we? Are you listeners?
obviously the checking savings accounts, your personal deposits that you put in to your checking and savings, money going in, money going out, is one of the ways that banks make money. It's a source of income for them. They may give you some type of interest rate um, on a checking account. It may require to keep a minimum balance in there, and it can't go under that minimum balance, or you won't get your interest. Same on savings, you get an interest rate. Um, but with that, how all those deposits and everything affect banks is how they loan money, and that's the biggest source of income for commercial banks. About 60% of their income, commercial banks, comes from loans, either obviously to businesses or to individuals, and they make a big portion of their income on that, what is called net interest margin. So for your checking and savings account, they may give you 1% interest per year, or maybe 1.5 interest per year. And then they will make a loan off those deposits, say to you or me, and the interest on the loan, they may give us 5% interest to pay them back for loaning the money. So the interest we pay minus the interest that they're paying to their regular customers for checking and savings account, you see that net in there. If they loan me a certain amount of money for 5% interest on payback, and they're giving out 1.5, well, they're making 3.5% net interest on their margins. And that's one of the biggest ways that banks make money with that. So our checking and savings accounts and money that we put in the bank is a big, obviously, use for banks to make money.
Right. And yeah, so we consumers are one of their revenue sources. But I know that they are also always like kind of borrowing from each other. Like, what are some of the other revenue sources besides consumers that
Well, yeah.
they're
So
dealing with?
each bank has, reserve requirements that they have to have at the end of each business day. And that's controlled by the central bank under the Federal Reserve. So that's part of the bank's requirement of the reserves they have to hold. So, yeah. So, for example, Bank A, it doesn't meet their reserve at the end of the banking day, and Bank B has excess reserve, so they're over and above the reserve. So the banks have the same reserve, one's under, one's over. So the one that's under, as a requirement to meet their reserves, they will borrow, say, from Bank B, the amount, say they need, a crazy number like 50 million. I know that's, but just as an example, it's, um, they would borrow that 50 million. And basically these loans are just for the day. So they'll have interest on that loan to meet their reserves. So they'll borrow that for the day to meet their reserves. And then pay the next day, they'll pay that bank B back along with the interest that they charge. And their interest is really the only interest rate that the Fed controls. You see a lot of the Federal Reserve talking about interest rates and inflation and all that stuff, and I know we're going to get deeper into that, down the road, but they can really the Fed only controls the Fed fund rate, and that's the one that the banks borrow. So when Bank A has to borrow from Bank B, they use the Fed fund rate, whatever that is, on the interest rates to pay that bank back. Is how that works. The Fed fund rate, the Federal Reserve, which does the Fed fund rate, that is a guideline for every interest rate you see out there on how people borrow money for banks and all that. But that's another way that banks make money is, you know, helping other banks with their required reserves with that, along with the net interest margin that they make off consumer loans.
Gotcha. Okay. So then in this decision pipeline trickling down from the Federal Reserve to banks to consumers, what are the interest rates that affect you and me and everybody else? Like, why are they set that way for us?
Well, again, um, there's no set rate that banks go by. You obviously, again, they go by what the Federal Reserve says as far as what they're setting, say, inflation at, or um, as far as their interest rates and what they're going to do with the Fed fund rate. So if the Fed fund rate goes up, it's going to be more of an interest rate that they're going to give out to consumer loans. And normally, as the Fed fund rate goes out, the banks have a tendency to loan less money because obviously the interest rates are a lot higher as well. So it affects what the Fed fund rate, the guideline that they set out, kind of affects everything, going forward with what the banks do. They don't necessarily have a set interest rate. Again, they move it up or down based on kind of what the Fed says they're doing with inflation, and that affects because that inflation rate goes up and down by whether how much money the Fed is putting into the system or how much they're pulling out. So obviously they're selling treasury bonds. Um, to they'll sell more bonds. They'll take more cash out of the banks to hold at the Federal Reserve, and that takes money away from the banks. They have less money to loan, so interest rates are going to go up. And just the opposite as they put more cash in and buy those bonds back, then there's more money available for the banks to loan. Interest rates tend to come down. So that's how all that is kind of simply affects what goes on with us as a consumer on a daily basis.
Got you. Okay, that makes sense. So then, like, can you and I and other consumers in the system kind of reverse engineer, like, what does our interest rates say about the national economy at the moment?
That's a good that's a good question and a tough one. Um, but yeah, I mean our interest rates say a lot about what's going on with the economy again because how how everything's affect and how people are spending money basically. And a lot of people, which is a totally different subject, but every time you swipe your debit card or a credit card per se, there's interest involved in that. So when you swipe your debit card, the bank's making money off the swipes of interest from the card companies. And credit card companies have a lot less standards on what they can do with interest rates. Obviously, on credit cards, you're getting 29 to 30% a lot of times interest rate, which can affect and that affects us. I mean, to kind of get into your question, when inflation rates are up and inflation rates are high, people have a tendency to spend less. They have less money. Um, they have less cash to spend. Then a lot of it is they're using credit cards. And again, if inflation rate is 3, 4, 5%, whatever it may be, and you're paying 30% on a credit card, that affects a lot of what we're doing now, to affect inflation for people to continue their spending power. Interest rates have a lot to do with purchase power and spending power of what we get to do daily, with our just normal lives of going to the grocery or gas in our car, our vehicles. Um, it affects a lot of what we do every day, whether we have a little bit excess cash or whether we don't.
Yeah, absolutely. Yeah, I was just thinking as you were saying that about how, like, you know, we're kind of going through a little bit of that right now in the world and with our current economic situation, and how, we were able to avoid major fallout in 2021 when the pandemic was, releasing the impacts of that, versus like the 2008 crisis where it went very poorly for many people.
Yeah, and the 2021 in that area was more about, and again, in my opinion, was more about supply and demand. We heard a lot about, ships being out in the port. They can't get into the ports. They can't get unload. When, the demand is out there to buy things and do that, but the supply's not there. Obviously, inflation and everything is going to go up, as well. Um, 2008 was just an absolute panic on everybody. Uh,
Yeah.
when that happened, and a lot of it had to do with the market because people were losing money in their 401ks, and everybody was wanting to pull out, and there was just a major panic. And a lot of people were in a situation where they really weren't ready to retire, but they felt like they were losing a lot of money. They wanted to pull their money, they wanted to go somewhere else, and that has a lot of effect on inflation as well. Whether it goes up or down, but there's so many things that can influence interest rates and inflation and what banks do. And again, we're just kind of touching the surface here, just trying to give people a little bit of a better understanding of how that works. And as we go along, we're going to get more in depth with everything. But there's, again, yeah, you talk about those 2 years and what happened, and again, in my opinion, they were totally different things that were affecting inflation, but it it caused it it caused it to go up. Obviously, inflation to go up a lot, but with the two, which can do, a lot of times, um, unemployment is a big thing with interest rates and inflation because obviously we want people to work, we want more people in the workforce. Well, everybody working in the workforce can cause inflation because that goes back to a supply and demand type thing. Because everybody's working, everybody has money, they want to go out and spend, but there's not enough stuff. So, a lot of times unemployment can cause, bad things too with inflation and interest rates. So there's so many things that can affect it. And they're totally different areas.
Yeah, but it's always interesting to me how interconnected all of this ends up,
Yes.
between inflation, interest rates, banks, Fed, supply, demand, employment. Like it all is so interwoven.
Yeah. Oh yeah. Yeah. And again, the Fed fund rate is a guideline that everybody goes by basically with what the Fed's doing, and the Fed's doing it just to try to control inflation based on what goes, into consumers' hands and what goes out as far as what, putting, like we were said earlier, putting money in or putting out, to the banks. They can kind of control inflation, with that. And then everybody else kind of sets their interest rates on based on the Fed, the Fed fund. And, if they said it, they try to say inflation's 2%. Well, that's kind of the number they want to keep it at and hit at. Well, the bank, if they're giving you interest on your checking account and savings account at 1.5% and they're only getting, they're loaning money at 2%, well, their net margin is not making money, and they're probably losing because they got to pay their employees and everything else like anybody else. So, that net margin, if inflation's at 2%, they may be loaning at 5%, which inflation goes to 3 or 4%, they're going to be loaning money at 8, 9%, to try to keep those net margins with what they're doing. So yeah, there's so many factors that go into it, so many things that can influence it. Um, the Fed's got to control all that. Try to, so it's interesting and dynamic, and it's neat to look at and follow. Um,
Yeah, and keep trying to figure out day to day.
yeah, yeah, and people do, and it's hard. It gets tough at times. Like I said, with credit cards and people using those, and right now credit card spending is really really high because inflation's been up or down, and that affects what people do on their daily lives, just trying to stay at their standard of living that they're accustomed to. And when they have less money and your money doesn't go as far because of inflation and things like that, people have to get into credit cards, like I said, and then we're paying a astronomical interest on that as well.
Yes. And I mean, that is a whole episode in and of itself. Literally, that will
Yeah,
be
yeah,
another episode in this
yes,
Minisode
yeah.
miniseries on
Yeah,
interest.
we're just and this, I love this. I get excited about it because yeah, this just builds on, where we're going with everything. And yeah, we want to get into, the Fed, and we want to get into, credit card and interest rates with that as well. And it's it's all just intertwined and fascinating to talk about because you could go for days. You really could.
And we will, and you all get to hear
Yeah,
it.
exactly. Yeah, we'll be here to give it all. Yeah, absolutely.
That's right. Yeah, like we said, we have a couple more episodes in this mini series, credit cards and more. I'll wait to reveal it to you later. And in the meantime, you can of course listen to our other episodes, both full and mini of In the Final Analysis on our website or on our YouTube or wherever you listen to podcasts. We should be on all the apps. As well as we have white papers on what's going on in current events in the economy right now. Um, and we have both white papers and podcast episodes dedicated to the Federal Reserve if you'd like to know more about how they operate. All right. And then, yes, like I said, you can subscribe to the podcast so that you're the first one to know when our next episode on analyzing interest rates comes out. As well as sign up for our newsletter on our website, wisdomchoice.net, to be able to be the first to know.
Yeah.
All right.
We bombard you with information and knowledge and education, and it's good to get in there and look because it helps everybody. The more understanding you have about it, the more it helps you going forward for your retirement planning and everything that goes on. All this affects, all those things. And it's you never you're never too old or too young to be educated, so it's a
Absolutely.
positive thing.
Absolutely. And we always say this here at Wisdom, we are education first, service second. And we are actually recording this during Financial Literacy Month. And so we hope that you will take advantage of our wealth of resources that we have in order to help better inform your financial literacy based knowledge, but as well as your personalized money mindset and behaviors. All right. Thank you all so much for listening. Thank you, Joe, for joining me again.
Absolutely. Enjoy it always.
Yes. And we will see you all next time. Bye.
Thanks for tuning in to The Final Analysis. We try to keep you informed. Be sure that you're on the email list and call us if you have any questions whatsoever. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professionals before making important investment decisions. Securities offered through Cambridge Investment Research, Inc., a registered broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Wisdom Financial Management, LLC are not affiliated.